Awesome. Well, I'm going to start with a story. All I'm doing is talking about what I'm working on. That's it. So I've had 30 years in the business. We have bought over $3 billion worth of assets. I have 300 employees. We own stuff in Texas and Oklahoma. We just bought in Vegas. Obviously, we're doing a bunch of stuff in Arizona. But I've been just doing multifamily the whole time. What I really wanted to point out here is what I think a lot of people miss. It doesn't matter what you pay. The price is it's important, but it's almost irrelevant. Because if there's nobody to rent your storage unit or rent your multifamily or buy your house or walk into your retail shop or whatever it is, it's just not going to do well, no matter what you pay. You can't manage your way out of a bad neighborhood. I can buy a property, I can dump money into it, I can try to get good people in it. But if the surrounding area is working against me, it's just not a good idea. So when I'm looking at where I'm going to invest next, I'm looking at, is a city, is a state, is a town, are they moving out or are they moving in? And why? Because what we all want to do is kind of be ahead of that, not necessarily a pioneer either. You don't want to be a pioneer and emotionally get involved and try to convince. This is not a sales job. This is doing the homework. People create demand. I've seen time and time again where people buy on the fringe of town and they get a deal and then they struggle to find a tenant or whatever it is. And then they're like, real estate sucks. So part of raising capital, part of managing money for other people, if you're raising it for others or yourself or whoever, is making the best decision on where. For that, it's super important when you start to look at, if there are people going there, then it's going to be a problem. It's going to be really difficult. Yes, you can pay a lot in marketing, and yes, you can do all these things. What you want is a balance of people moving in their direction so that it helps you. So what happened with a lot of money raisers in the last 10 years is they thought that this was normal. They thought that, we get 5, 6, 7, 8, 10% rent growth. That's normal. It's not normal. My entire career, I got the hell beat out of me. Interest rates that went up and down with regulations and policy. And we didn't have what we just went through. I never experienced low interest rates like that before in my career. In fact, mostly in the 30 years I've been doing it, I've been in the 5 to 6s. This map is available on the internet. It's a U.S. Census. It's easy. But I'm going to give you a bunch of other things that you can look at. So each dot here, each blue dot represents 100 people moving in. Each red dot represents 100 people moving out. Hopefully you understand where this is heading. This is migration. Now, this is just a couple of years ago, so census is usually a little bit behind. There's a bunch of things that predict this, right? So you think about policy, government policy predicts this, right? You think of a hurricane, even though Florida, I don't know, a lot of people moving there. Insurance rates, safety, weather, family, all that stuff, work from home, COVID, pandemic, fires in California. Your job as real estate investors is not just to raise money, because honestly, raising money, it's not easy, but it's not the hardest thing to do, especially if you have an internet platform and especially if you have a group of people. The last thing you want to do if you're thinking long-term is you want to make sure that you're investing well. And so these are really important things. Again, you want to go where people are headed. So you can see up top, Seattle, I'll pick on that because that's where I'm from. A lot of people are moving, but they're not necessarily moving out of Washington. Then you move down to Portland, same issue. Then you go down the coast, right? And then you start to look at where are they going? You take a look at New York, take a look at some of the others, and you can kind of see that people are leaving. However, doesn't mean that the sky is falling and you have all these problems. It just means that this is really important. But what I really want to pay attention to here on this chart, Detroit at one time had 1.8 million people. Now, this is a long time ago. Now it has like 650,000 or something, okay? So the real issue is, where did that million people go? That's actually what you really want to know. It's where did they go? What you're trying to do here is you're trying to go where the blue dots are. This changes in this area. For those of you who are here, or let's say Vegas, which I also just bought a property there, we're starting to see already the people moving from Southern California because of the fires. Horrible thing that happened, but the reality is people relocated, and for reasons that you might not think. What I've been seeing here locally is that people are trying to get their kids back into school. And so they're picking a spot. Where do they want to be? What's that going to do? That's going to put pressure on rent. That's going to put pressure on house prices. That's going to put pressure on all kinds of things. With the wave of people, the wave of employment, the wave of population growth matters. And so there's a couple other things that you can do here to get more accurate information, because the census is just a little behind, but I'll give you a couple. One is out-of-state driver's licenses. That's a data point. It's available on the internet. U-Haul trucks. One-way trips from Seattle to Phoenix, that's a data point. North American Van Lines, that's a data point. So you can start to see, even during the pandemic, where people are heading. One-way trips, by the way. Is it completely accurate? Maybe not. The best one that you're starting to see right now, and I would encourage you guys to look up, if you think about it, it makes complete sense. Cell phones. And the reality is so the data that you're able to get to make these kinds of decisions is phenomenal, and it's changing. And it's your job as capital raisers to make sure that you have the best and you can make the best decisions based on fluctuations of where people are going. Because again, without people, there's no housing demand. And homeownership rate, nobody really watches this or pays attention to this too much. What the policies are of the president, not, and this is big picture, I get it. But I want you to take a look at what that line did. You probably know that there's somewhere in the 340 million people in the United States, something like that, all right? I looked, there's about 250 million that are either owning a home or renting a home. But the reality is we went from 64% home ownership. So what does that really mean to me? When I look at that, I look at 36% rental. It's really important. So I look at the other side of the equation, 36% rental. Okay, so then all of a sudden, Bush pushes all the way up to, I think it was 69.2% home ownership. So what was going on during that period of time? I was getting my lunch eaten. I was just trying to keep tenants. Because why? No money down, low interest rates. That's exactly what created the great financial crisis, was getting people into homes that couldn't afford homes. We all know the story. And I was denying people in my own apartments. And all I do is say, I need 3 months income to be able to afford the rent. I would deny them as a rental and they would buy a house. And so what we saw was a massive fall from 69% all the way down. Now here's the data point I want you to pay attention to. For every 1%, so call it 64 to 69, that's 5%. If there's 250 million renters or homeowners, that represents 2.5 million people that have a choice. So you're talking about 10 million people from 95 all the way up, let's call it 10 years, that transferred the ledger over to home ownership and then back. So that's what created the rent growth. The people that lost their homes and the people that were going through all the trouble that they went through, the great financial crisis, they had no choice, a lot of them. They turned their keys back to the bank, they moved into apartments, and then, of course, we all benefited. And then everybody started jumping in and started raising capital, said, oh my God, apartments are the best. That's because of what was happening. There's a shift here. So it's really important to understand these on a macro basis. Let's look at the apartment deliveries. And we just looked at the demand side. This is the supply side. In the 90 to 93, which is a time frame when I was just taking off, the interest rates were really high. When you have interest rates that are 9%, people pull back that are building, because the cost to build, the mortgage payment, the interest on that construction debt is onerous, and it doesn't make sense financially. So that's when you start to see these light blue, it's directly as a result of the high cost to build. A builder will build if they can, and they'll build every time. So if there's demand and the price is right for a developer, they'll do it. This is what I track primarily, but there's also a graph for single family. And you can kind of follow all of this. And what's really, really interesting is that we had a historic high last year in 2024. In 2024 and 2023, there was a little over 1 million units delivered to the U.S. So the question as a real estate investor is where and why and how long will it take to absorb, period. Those are the things you watch. So it's not a bad thing that a lot of units got developed, because as we all know, we've got 2 to 5 million housing units short. We never caught up from the crash. So the reason we're undersupplied is because when the crash hit, under Obama, and banks were taking on all that paper, and they were like, I'm not supposed to own real estate. I own real estate now. What am I supposed to do? They weren't lending. That's what they weren't doing. So they weren't building. Meanwhile, as I showed you already, the population continues to grow. So what's happening right now, the high point here, you've got a number of units hitting the market. Why? I want disruption. I want high vacancy. I want developers that started building in 21 or 22 and their interest rates were 4 and 5% because I'm a builder, and now they're 9. That's what I want. I want to talk to that person. Construction debt is in trouble. Floating debt is in trouble. People that didn't buy rate caps are in trouble. People who didn't have proper reserves are in trouble. There's a whole bunch of people in trouble, as we all know. That's what I'm trying to find right now. And that's what we are finding. So we're able to come in and buy properties below replacement costs. We're able to buy properties that have problems. Now, obviously, we don't want to buy below market. We don't want to buy below loan. We don't want to step into somebody's shoes when, there's a bunch of mud on it already, but you get the point. Anyway, so that's where we are today. And so what we see is when rates started going up, let's call it a couple of years ago, when inflation hit 9, people pulled back. Apartments pulled back. Everybody pulled back because, again, the cost of debt. My cost of construction debt is 8-9% right now. And what's going to happen is because of the lack of construction, the supply that is already behind, all this stuff's going to get absorbed, and we're going to see rent growth again. But this is my prediction left to right. Single family, trapped equity stays put. Refinances, I think, are going to be flat. Sales are flat. Net migration, again, it's going to drive pricing. Inventory grows, but it's slow, and it's going to grow because I think people are going to be in some financial trouble here and there. The gap between own and rent, this is a big one. I always watch for this. I want 1,000 at least, or 1,500 or 2,000, if I can, between a single family home and an apartment next door. Okay. I want the jump to be massive. I don't want it to be like in Oklahoma City. I was looking at a deal where the rents were $1,200 and you could buy a home next door all in with a mortgage at 6% at $1,300. Like, that's not what you want. So that you need to decide that before you go. And then you got construction is flat. And I already, except for the single family home builders, they're getting kind of crafty right now. They're buying down the rate for like a year. That's actually competing against us, anybody like us, like people that are just listing a house. Interest rates, I think they will go down a little bit, but we'll see. We'll see what the Fed does. Debt service coverages are definitely up. Loan to value is way down. Talking about 50%, no more than 55% loan to value. That's a significant difference. That means more equity. And depending on your costs of your loans and your equity, we'll see. Refinances are down. Inflation is up. I can't see any way around this. I went back and looked, Reagan, George W., they were in the 4 or 5%. Biden was in the 4 or 5%. The presidents you just saw were in the 1 to 2%. The Fed wants 2%. Who knows? But I think we're going to see inflation. That means that you should be in hard assets, period. You should be in fixed rate debt, hard assets. Regional bank problems, I do think that's coming, mostly because of office buildings. Rental rates are flat. I'm buying a building right now in North Scottsdale, and the very first question the seller asks is, what did you budget in the first 2 years for rent growth? Fences are up, cap rates are up. That's created, the values are down. So anything that was bought in the last 2 or 3 years, office defaults are disrupting things. And we're going to see multifamily defaults. A lot of people are out of cash, and then new construction is flat, which exactly, and while this all sounds bad, it's exactly what I've been waiting for, is disruption. Maybe I'm a little early, I don't know. But the last thing I want to do is wait till it's all right in front of everybody, and then everybody starts raising capital again. That's precisely why we're going to be so aggressive here in the next 18 to 24 months. And by the way, thanks for being here. If you want to see an exclusive behind the scenes look at one of my properties, I just walked through this deal with my partner, Ross. We went over some tips for buying and managing real estate. You can watch this video now.